What's up, guys? I'm Nobody Special, and I have a special guest with us. Back once again is Bob Coleman. He's the CEO of Idaho Armored Vaults, and he is here to talk to us about the gold market today, some of the pitfalls of investing in gold, some of the things to watch out for, some of the maybe less scrupulous investors or less scrupulous dealers that are out there, and some of the tells. And Bob, you're joining me on a pretty good day. I mean, we scheduled this interview last week, and as it happens today, gold just got clobbered once again. We had a big sell-off on this breakthrough with the trade deal, or not a trade deal, depending on who you ask. We'll say progress in the trade war. Now, I just wanted to, before we get going here, just kind of like revisit where we were the last time we got together, because here we're looking at daily candles on the gold chart. And we last spoke, it was about April 5th, and we were right in the middle of this little sell-off here, right after Liberation Day. We saw gold sold off from about $3,200 all the way down to $2,900. And then, of course, we did the interview then, and your message was, hey, don't get caught up in the volatility. Remember why you bought gold to begin with. That was a very good message, calling for calm. And, of course, it paid off because gold would go on to rally pretty substantially from $2,900 up to about a peak of $3,500 a few days later. Now here we are, about a month and a half later, and once again, we're kind of in the middle of a little bit of a couple of days sell-off here. Pretty brutal today, down about another $90. So I wonder, before we get into some of these more particular stories, if you could just give me your overall thoughts on the gold market today as it pertains to all this geopolitical nonsense that's going on, stocks ripping, everything else moving around. What do you see going on in gold markets here?
Yeah, you could almost say there's a lot of financial engineering, I guess would be the word, or political engineering, trying to make, sometimes putting the lipstick on the pig, so to speak, and making things appear a lot better than they actually are. The issue that I'm trying to figure out is, okay, if you go back 3 months ago to today, what actually has changed? I mean, like you were mentioning offline, the tariff rate has actually gone up, and everybody's cheering for it. But now you're having the issue of, okay, now economies are, they're being impacted. They're slowing down. You're seeing, interest rates actually rise. The dollar's actually starting to go back up here a little bit, because this expectation that maybe the economy isn't going to just completely fall apart. And at the same time today, which really got caught kind of behind in the headlines because of the Chinese tariff talks and so forth, was, the Republicans passed a budget bill. I guess they're looking at $4 trillion of deficits, which is going to just ratchet up the deficit. That's really the game at the end of the day that I think people have to kind of watch for. This volatility is going to be day to day. It's going to be sometimes very extreme. And I think that has to do with sort of the message that the president and his administration is trying to push, is maybe sometimes you have to be a little extreme in order to get your message across. But I think the biggest worry right now that people are going to be focusing on, not just 2 weeks from now, but more into the summer and then going into the fall, is really the refinancing of a lot of U.S. Treasury debt that's not only going to roll over, but a lot of the deficit spending that's going to start hitting the market in June, July, August, right about the time when you start to have the Treasury general account fall to zero or close to $0, where they're going to be forced to actually increase the debt ceiling limit and then be forced to come up and bring more Treasury supply back into the market, which is going to start sucking liquidity back out of the market. So there's this pumping game that's going on right now, but that's eventually going to meet the wall when you start to see Treasury supply start coming back into the market.
Yeah, that's a very good point there. You're looking forward like a true chess player, if you will, 3-4 moves ahead here. Yeah, right now all the focus is on the tariffs and the trade war, but you're right, there is this looming debt showdown that's going on once again. We repeat this circus every couple of years. And if you go and look back a couple of years ago, I believe it was 2023 the last time we did this, there was a surge of new Treasury issuance just as soon as the debt ceiling was raised the last time. And all of that new issuance, that new supply, suppressed bond prices and sent interest rates sharply higher in the months that followed. And interest rates rose in almost a straight line for about 6 months. It didn't end until about October of 2023. And so we do have that on the horizon. We've got significantly higher interest rates if that series of events repeats itself. And it really does look like that's going to happen. So how do you see the metals market reacting in that scenario if we do go down that road?
Well, you have to remember too, and that's a good point that you brought up with the wave of treasury supply. What Yellen did back then was front load 80% or 75% of the debt that came to market in T-bills. And then those T-bills were actually used by hedge funds and money managers as collateral in the repo market to then go out and buy more assets. And so they leveraged, or they played the basis trade where they bought the long bond, they shorted the treasury futures, and they were able to lock in some kind of fixed small basis point trade, which brought in a lot of money because you're dealing with massive leverage, and a massive amount of debt. That game has been sort of turned off with this constriction of liquidity that we've been seeing with the tariffs and the concerns out there. It's not this sort of feel good atmosphere of we're going to just party like it's 1999 anymore. I think you're seeing declines in volumes. You're seeing, you see that decline in volume in commodities and stocks and so forth. I think it was a couple weeks ago that you actually saw in the NASDAQ market, half of the volume, I think I was on a Friday, came from like 5 penny stocks. I mean, it's just, you have this sort of constricting of volume and constricting of sort of appetite for risk. And that's going to, when you're rising on lighter and lighter volume, those are the things you try to watch out for in a bear market, because when that strong selling comes in, it really tells you there's no one really underneath the surface. It's just been kind of going up on hot air, and I think that's what you're going to have to watch for when this rally sort of runs its course, and the Treasury starts coming to market with more debt. And there's an idea why people say sell in May and go away is you typically start to see the U.S. Treasury start coming to market with more paper. You get the April tax receipts that kind of supplements the Treasury's general account for 2 or 3 months, and then eventually June, July, August, they start coming to market with more debt because they've run down their cash reserve. Well, they're talking about increasing their Treasury general account back up to $800 billion. Well, if you're down at 50 billion by mid-July, for example, and now you have to run it back up to 800 billion over the course of a quarter, that's a lot of debt you're coming to market with. And that debt is going to have to it's going to force players to liquidate other assets to support that market.
So something else we talked about last time we got together was the gold to silver ratio. And I want to shrink us here. Let's look at the chart. This is the gold to silver ratio, the number of ounces of silver it takes to equal the price of 1 ounce of gold. And when we spoke back in April, we were right in the middle of this monster rip in the gold to silver ratio that we saw after Liberation Day. And we blew out to over 100. Now, here we are. We've been kind of bouncing around a little bit. Gold to silver ratio dropped pretty significantly today. We had a big drop in the price of gold, but silver kind of held in there today, didn't it? So what do you see going on with the gold to silver ratio? Does this chart tell you anything?
Well, it's sort of a little head and shoulders that's forming on the daily chart. So that's something you want to watch for. Head and shoulders patterns, for the people that don't realize it, is sort of a reversal to the downside of whatever that chart is representing. So in this case, a gold silver ratio that starts to decline would actually be positive for silver, meaning it'd be less ounces of silver would make up 1 ounce of gold. So I think what you're seeing is a lot of hedge funds, money managers, so forth, that were maybe shorting silver, going long gold as this ratio was blowing out, or maybe they were long silver and short gold and they got squeezed and forced out of their positions. Seems like that has sort of run its course. So now the question is, as industry continues to buy silver, and silver is one of these metals that you just can't replicate very easily, and the U.S. imports about 330 million ounces a year for industry use. Demand actually doesn't constrict like maybe a lot of funds out there were thinking, okay, all this tariff talk and so forth is going to be economically destructive. Well, maybe if it isn't as destructive as people thought, and demand continues to stay somewhat strong, and supply becomes constricted. So now that has run its course, the question is, well, if the economy actually doesn't fall apart and industrial metals actually start to become in vogue again, you may see players starting to go after the gold silver ratio, for example, shorting gold and going long silver. And that could have been what started to take place today.
Now, we saw a similar move, maybe a much more exaggerated move following COVID with the gold to silver ratio. We went up as high as like 125 back then. We didn't go that hard that fast this time around with the trade war. But coming out of that, it's funny you mentioned, maybe it turns out the economy's not that bad. Maybe that industrial demand never really goes away like we thought it was. That's exactly what happened in 2020 coming out of COVID. And we saw the price of silver as the gold to silver ratio corrected. We saw the price of silver rip. I mean, gold did very well in the first half of 2020 also, but silver dramatically outperformed. And ultimately, the gold to silver ratio bottomed out at about 62. Could we see a similar scenario playing out here?
Yes, I think that's what's going to end up happening. You had in March of 2020, or I should say 2020 in general, that gold silver ratio stayed above 100 for about 9 weeks. We're about 6 weeks into this move right here, so we're fairly well stretched in terms of time frame. And just for full disclosure, I run a hedge fund in physical gold, silver, platinum, but I've been increasing my buying of silver as this ratio has been rising, with the expectation that I think silver will do again what it did before. Is it when it does reverse, it'll be, it could be sudden, it could be dramatic, but I think you'll see outperformance on silver relative to gold. And I think that'll maybe be a clearer picture that maybe the market for the metals is broadening, which will help provide platinum, for example, which has been in the doghouse for a long time. It'll help these white metals, I think, capture a little bit more of that money flow exposure, and it'll kind of lift that price up.
Yeah, platinum really been struggling with the automotive sector and its struggles recently. We had Nissan announced another, I think, 9 or 11,000 layoffs today. Platinum, totally tied to the auto industry, absolutely.
Yeah, and not that to mention the gold to platinum ratio. It got to a point where it got to 0.28 gold ounces for every 1 platinum ounce, which I don't think I've ever seen it in the history of mankind that low. And this was just like the gold silver ratio being plus 100. Where in its natural state it's like 10 to 1. The platinum is 20 times rarer than gold is, and so for that thing to be at 0.28% or 0.28 gold ounces for every 1 platinum ounce, I mean, that's really, really low. And so that's what kind of interested me to start buying platinum in the fund a couple months ago, was with that ratio as low as it is.
That's interesting. I had David Morgan on the channel last Sunday, and he said the same thing. He was very passionate about platinum. He referred to it as one of the biggest asymmetric bets that's out there right now. Same thing, calling out the underperformance of platinum relative to gold. Any kind of recovery in the automotive sector, we should see platinum rip coming out of that. Well, okay, that's 2 data points. Two people in 2 weeks that are loving platinum here. That's interesting.
Yeah, it's interesting. I read HSBC's research about a month ago. They're looking for not a big move this year in platinum, but I think they were looking on an average, I think $1,300. I think at the end of 2026. So platinum is just a small market. You have to understand this thing can rock just like silver can to the upside or downside. It's just a very, very small market. And if you look at the commitment of traders' positions in platinum right now, managed money is still net short platinum. And platinum has had this really constricted sort of pennant formation where it's been making a series of lower highs, higher lows for 3 years. And I think 2026 is where it hits its apex. So typically, usually you have a big move before that apex hits. And so, given that there is so much mining destruction on platinum because of the low prices, that hasn't done much over the years. Platinum is basically working off its above ground stocks, and that above ground stocks, if you're kind of in the commodity market, that's what you want to see. It may take a long time for that to happen, but as a longer term investor, you're trying to watch for certain events unfold. And one of those is, hey, listen, if above ground stocks are now depleted or becoming depleted, and mining activity hasn't, no one's put any money into platinum because it hasn't gone anywhere. all of a sudden you got this perfect storm that's forming, and that's something you want to watch for.
Another story I heard a lot about recently, or for really like the last year and a half, I've been hearing a lot about this. I've been hearing about the Costco gold bars and how Costco's selling, they're moving so much gold. And I saw a lot of chatter about this in particular over the last few weeks in and around Twitter. And I want to show you this one here, this headline we've got from the U.S. Sun, the gold rush. Costco puts a purchase limit on viral gold bars after selling out within a week. And a lot of the gold bulls are out there. And look, I'm a gold bull. I'm a precious metal enthusiast. So I like a feel-good story about gold. But then I'm also hearing all these other things about how premiums are shrinking and virtually non-existent, which would suggest that there's excess supply in the retail bar market. So these two stories, Costco selling out of gold in a second, putting limits on the place, it seems to be diametrically opposed to the prevailing narrative that there's not really any tightness of supply in the retail market. So what's going on here?
Yeah, there's a couple of things that are happening. Costco does a magnificent job of marketing. I mean, and when you put a limit on something, that tends to want, people want it more, I guess you could say. The moment you can't have it, that's when you want it the most. But with Costco, it's a little bit different. They're not set up like a gold dealer. They don't have a bid offer system where they buy back metals. They don't really deal with market volatility and pricing and have a spot price that's floating up and down. When you go to the jewelry case and you look at the gold bar, they just basically put it out at a certain price. And if the price keeps going higher on gold, all of a sudden that becomes extremely lucrative to say, listen, I'm going to grab that gold bar, because now if you're not necessarily just an enthusiast or consumer that wants to hoard the asset for savings, that type of thing, what's happening, and I've been talking about this for the last year and a half, is that the industry has been seeing a lot of this Costco gold coming back into the wholesale market, because what's happening is people are making money on the arbitrage. They get the 2% cash back, then they get the points on their credit card, and then they can go ahead and just turn around and sell it and just do a wash, rinse, and repeat all over again. And what happens is you start to see, this product start to enter into the wholesale industry. And then, with Costco, the funny thing is, a lot of the sometimes the packaging is very specific to Costco. So Royal Canadian Mint may make a package that has Costco's name on it. It's a 1 ounce maple leaf, still the same 1 ounce gold maple leaf you're going to buy if you buy from a tube from a dealer online or locally, but it just happens to be wrapped in a nice little plastic package. Well, the wholesalers are having to take those packages apart because they obviously don't want to be reselling, someone else's product, so to speak. So, and that's sort of what's been going on, and you can kind of see this with the volumes that we've been seeing just in the industry itself, with gold and silver and the sales of ounces of gold and silver ounces.
So not an insane demand for these Costco gold bars, although I'm sure, they're selling some of it. You got your impulse buyers. You got to walk right past it when you get into the store. They put the big TVs and the jewelry right there. Maybe you went for K-cups and toilet paper, but you're coming out with gold jewelry and a flat screen TV. Costco is the master of the impulse buy. But people gaming the system for 2% cash back on a credit card. And then the wholesalers are buying this stuff up, ripping open the package, and then selling it into the secondary market. Now, correct me if I'm wrong, that's a pretty narrow margin business. If people are out there really doing this, right? If they're arbitraging Costco bars for a couple of points on a credit card, because you're not getting spot when you sell to the wholesalers, right? I mean, the premiums are pretty low. So is this just dependent on the gold price continuing to rise for this to work?
Yeah, definitely. I mean, it's very similar to the basis trade with treasuries, very similar. So, the moment the pricing goes down, now all of a sudden you have a different scenario with Costco's pricing model, because they bought at a higher price, and they're not like a dealer that's just going to constantly lower the price, until they get out of the product. They may have a widening spread, so to speak. And that's when you get these types of volatile moves in the markets, where you're up $100 one day, down $90 the next day. It's a great way to kind of measure, how well Costco is doing, but go to the counter and see what the price of metal is after it drops $100 an ounce, and see where the price is for that bar.
Yeah, and be careful. I mean, if you're one of the guys doing this, keep in mind the problem with the basis trade is that you're picking up pennies in front of the steamroller, and we've seen firms get wiped out doing that. If you're doing this with gold bars at Costco, yeah, you're getting your 2% cash back. But if, say, we have a couple of days like today where the price of gold drops $100, you're not just going to sit there and wait because you bought it on your credit card. So you're eating what, 22, 23% interest on your credit card now while you're waiting for the gold market to recover. So it's a pretty dangerous game here people are playing if that's really what they're doing. Sounds like Costco got wise to it. They put the limits on there. And now, okay, you can only do it 1 or 2 bars a day. That kind of blows up that arbitrage trade.
Yeah, and it's great that you actually talked about the cost of carry, because what's happening in the retail dealer industry really over the last year with interest rates backing up and so forth, and you had lease rates go up, and after the tariff news and so forth, the cost to carry inventory has been rising, and that's just been an impediment of a lot of these dealers able to hang on. And so they've been forced to maybe liquidate inventory that's not moving, and that also affects premiums and so forth. We do have an interesting thing that has developed over the course of the last month and a half or so with the tariff news and so forth. Initially, the bullion was supposedly removed or given a sort of a hand wave, I guess you could say. But what's happened is a number of the refiners, a number of the mints, Royal Canadian Mint, Perth Mint, Swiss refiners, and so forth, stopped delivering metal into the U.S. About a month or month and a half ago, and that has sort of kept, for example, 1 ounce gold bar premiums are a little bit higher than what they normally may be on the wholesale front. And what's interesting is the gold eagles right now, which has been probably the most popular product in North America because it's been around since 1986. A lot of gold eagles have been coming back into the market because a lot of people have owned this stuff for 20, 30, 40 years. And so what's interesting now is gold eagles are cheaper, backdated gold eagles are cheaper than 1 ounce gold bars if you were buying them.
Wow, I've never heard of that before. So you can get gold eagles right now, say in 1990 or a random year in the secondary market. You can get that for less than, say, your 1 ounce in an assay card gold bar.
Yep.
No kidding.
Yeah, and that's a function of some of the stifleness of supply coming into the market because of the tariffs, and it's really the refiners and the mints that just don't want to deliver product into the U.S. because there is a lot of exposure in case Trump changes his mind and says, okay, maybe we're going to put tariffs on everything all over again. Psych. And so that becomes a huge risk because 10% on hundreds, $10 million or $5 million of metal, that really adds up fast.
Now, there's something you've been pretty vocal about on Twitter recently about the dealer. Obviously, you've always been pretty vocal about this. The dealers overhyping the retail trade, preying on people's fears. But you've been talking a lot about A-Mark recently, and I got a chart up here. This is going back to about 2020. Now, A-Mark, one of your bigger retail gold dealers, this is the parent company of JM Bullion. I think they own a few others. They reported earnings recently, and it was pretty awful. Their earnings report, they took a dive, and now here they are trading at 4-year lows. This is a company that sells gold. And, okay, gold is off its highs right now by a few $100, but hey, $3,200, we would have been jumping up and down celebrating a few months ago for $3,200. How is A-Mark getting crushed here? What's going on with them?
Well, A-Mark is really the behemoth of the entire industry. I mean, they are sort of the heartbeat. They obviously have a huge wholesale footprint, a huge retail environment. They also own, I don't think a majority stake, I think 45% stake in Sunshine Mint in Silvertown. So they're involved in the refining operations. They're also involved on the collectible side. They have a big footprint there. So they are truly, when you look at that company, it really gives you an encompassing feeling of what the industry is actually going through. And it's something that I talked about a couple of years ago, I think in 2022, I did a podcast for Spaces talking about, hey, listen, I think premiums have peaked. The industry has made a lot of money in a very quick period of time from 2020 to 2023. And now things are going to start to reverse the opposite direction. And that's exactly what's happened. Even as the prices have gone up in the metals, the issue you're running into is the industry was fixated on sort of this one-way sort of street. People are only buying, they're not selling. And that kept premiums really high. But now all of a sudden, when people started to sell back into the market and dealers are taking in that inventory and carrying costs are rising at the same time, you can't afford to hold on to that inventory for very long. You're just going to get murdered on your profit margins. And that's exactly what's kind of happened here in a way, as not only prices have gone up, people aren't chasing the price anymore. The traditional gold and silver investor always sort of bought on the dip, expecting smash down in price and going into the market and then buying, and that hasn't happened, because prices have been going up, and the retail hasn't. The retail has disengaged itself over the course of the last year and a half, and that disengagement has floated through A-Mark's business model, because they have a number of different retail dealer operations online as well as full service, that sort of cater to that volume and flow. And so nothing negative about A-Mark. This is just a symptom of the industry.
So why do you think that retail disengagement is happening?
Well, part of it is, and I've been warning the industry about it. I've been just ad nauseum talking about it online with on different podcasts, on social media. The premium environment was so grotesque. It was so overreaching. It took a lot of people's money out of their own pockets that were trying to protect purchasing power, but all they were doing was giving the purchasing power back into the online dealer or a local dealer that just was trying to it wasn't just the retail dealers. The wholesale industry was actually marking product up quite a bit as well. And you just had so much money coming into the industry. Now what you have is just the opposite. With the flow sort of trickling now out of the faucet. For example, PAMP, MKS PAMP, which built a refinery down in Florida, that closed down. They couldn't make enough product to make it profitable. You have Asahi, which is a huge global conglomerate. They closed down the Miami operation, which actually that was the old Republic Metals operation, to stop making retail products and focusing more on retail, or on the 1,000-ounce gold bar and the larger 1,000-ounce silver bar and the 400-ounce and 100-ounce gold bars that are traded on the COMEX. So they're focusing more on the bigger money management side of the business, not necessarily the retail, because the retail just has not been there to support that type of activity and profit margin. So these are all signs that you're seeing that the industry is reacting to, and it's just confirming what I've been saying for the last year and a half.
Is retail maybe just a little bit exhausted too? The cost of living jumping 20-30% since 2020. And one thing I've heard you mention in a couple of our interviews was people using their gold holdings as source of funds, i.e. just they're selling their gold and silver investments not because they want to, but because they just have no other choice. They can't pay the bills without it. How much do you think that is contributing versus maybe the industry just killed the golden goose with their overjacking of premiums?
Yeah, I mean, you certainly have. You look at the typical retail investor in physical metals, it tends to be an older generation. So the plus 60 crowds, for example, and as they age out, you just simply have a change of financial interests where they now need income. They can't just rely on potential appreciation of the metals, that type of thing. So now they're selling the metals, trying to get income off of maybe now that rates have come up from zero back 5 years ago. Now they're 5% or 4%. You can get some kind of yield, and so you have that transition, or you have that older generation that says, "Listen, I need it for living needs. The whole lifestyle has changed," and I think that's certainly affected things as well. And that type of impact. it's part of the problem with the industry's sort of image with the younger generation, being that the younger generation is obviously more fixated, maybe more on digital products with crypto and so forth, and the price movement, and obviously Bitcoin going through the roof, and having that type of winners sort of take all or get rich quick type of scenario. The metals are more of it's more of the longer term race, the turtle versus the hare, so to speak. The problem is most people don't have the time to go into the gold or silver market, wait years for that sort of appreciation to take hold, or the recognition that take hold. They want the immediacy that maybe the digital products and that industry can provide. So that's a shift in generational culture almost. And but at the end of the day, the larger players still are buying gold and silver. Maybe they've pulled back a little bit here recently because of the high prices, but unless we truly get change, not only in the financial system but also in political cultures around the world, the question is, things are I think ultimately slowing down, and that these governments around the world are trying to figure out, how do I keep refinancing my debts? How do I keep the treasury, which is fixated on deficit spending? How do you sell that new debt to a potential buyer? And that's one of the reasons why the metals still make a lot of sense. Ultimately, the Federal Reserve is going to have to come back into this market. There's not a, they're the biggest buyer on the block, and if the House and Senate and so forth don't get their fiscal house in order and just keep spending money, and just growing deficits, they may juice the economy, but at some point it's going to create this sort of debt debacle, I guess, that is going to impact the currency, and that's sort of longer term game with the gold and silver.
Yeah, I mean, we've already seen Europe do that again, right? They just passed all these. They got rid of their debt breaks, whatever that is. They just pencil whipped that away. I mean, they forgot all about inflation real fast, didn't they? The second that blow up happened in the Oval Office, and now how far behind are we? I mean, every politician runs on fiscal discipline, and then they get the checkbook, and they just do the same thing everybody else did, don't they?
I think they forgot about that as fast as they forgot about the cocaine and spoon that was on the table over the weekend at a press conference.
Let me just take that off the table and nonchalantly put that in my pocket. Yeah, that was who was that? Starmer, Macron, and was it Merz, the new guy in Germany, was in that meeting?
Yeah, maybe. Yeah.
Yeah. Whoops. No, pay no attention to the drugs on the table. Certainly, we probably just got demonetized for that one, but it was worth it. It was funny. All right. The last thing I want to talk to you about, Bob, because you're very good at pointing out the pitfalls of investing in gold and silver. It's meant to be a safe investment. It's meant to be a way to, avoid all the rabble and the thieves and the crookery that goes on in Wall Street. But this industry is not immune to it. And you're one of the few people that ever highlights this and calls it out. It's one of the reasons why I like having you on the channel. I want to share this tweet that you posted recently, saying silver and gold dealer to pay $57 million in SEC fraud suit. Safeguard Metals LLC and its owner were ordered to pay almost $57.4 million to the Securities and Exchange Commission, wrapping up a lawsuit claiming they swindled about 450 elderly investors out of roughly $67 million for gold and silver at severe markups. Could you tell us a little bit about what happened with this story? And more importantly, what are some of the red flags that somebody might look for so that they can spot the next Safeguard Metals LLC and we don't have more victims of scams like this?
Yeah, this is, I believe this was an older case, I think 2020 or 2021, 2022, where they were charging obscene markups for, I think maybe 1.5 ounce, 1.25 ounce or 2 ounce type products, silver products, or 0.25 ounce or 0.5 ounce or 0.75 ounce gold products. So that's what you tend to see with some of the stuff is these dealers will get these special or limited series products made by the Royal Canadian Mint, whether they're wildlife series products or maybe some of the islands that are under the that sort of have the royal name behind them. But what they'll do is they'll sell these products as if they're sort of a special or collectible type series, where in essence they're really just bullion products that are just very limited mintage series that the dealer will say, hey, listen, it's, they may use the term numismatic, but in essence, most of them will say this is a limited edition type product. It's a small denomination, so therefore you can spend it at the grocery store, but it's a made by a world renowned mint or that type of thing. But what ends up happening is they sell it on the concept that it's very limited in edition or limited in quantity. So the markups may be 30, 40, 50, 60, 70% of the product. So literally the price would have to double just to break even in a lot of these instances. And that's ultimately what has happened with a lot of the elderly clients that a lot of these types of firms will prey on. Or first time buyers that just don't understand the gold market. And so they'll try to go to these dealers expecting them to be, based on their marketing that you may see online or on TV, well, God, they must know what they're talking about. They have, these celebrities as endorsers and they may follow a news channel that's very conservative oriented that, it gives people a sense of credibility, but in essence, they just do a great job of marketing, these types of products that really are no different than, just a normal 1 ounce maple leaf, for example. You don't need to pay 40% markups on those type of products. So you shouldn't be paying 40% markups on a 0.25 ounce size coin. So that was one of the issues that that plagued, I believe, this company, that they ended up a number of states also enjoined in class action suits against similar companies as well. So this is not a one-off. This is something that's happened in the industry, is very pronounced over the last 5 years or so, especially when a lot of money came into the precious metals world.
So a couple of things there that maybe could have warned, or some things to look out for. You've got your exotic weights, your 1.5 ounce or your 3/4 ounce, right? That's not a very deep liquid market for a coin like that. It's a very niche buyer, so you're probably going to have a hard time selling something like that. Certainly the limited edition and the numismatics. I can tell you, I've seen that so many times where these dealers pump this stuff. Maybe they prey on people's fears of gold confiscation and say, oh, this isn't bullion, though. This is a collector's coin. And in 1933, they didn't confiscate collector's coins. Okay, but in 1933, they also didn't go door to door and take 1 ounce gold bars either, right? They went after the big guys. So that's another red flag there, the numismatics, the pumping that. And, look, the markups are so high and the salesmen push this stuff because they probably get better commissions on this stuff. So you got to wonder what are the motivations of the people on the other side of the trade there. And the one thing that you really pointed out that I think drives this home is the celebrity endorsements. These things cost money. Mm-hmm. And I'm a very firm believer that a good investment sells itself. It doesn't need to be advertised. And that's just generally, I think, good advice. It's one of the reasons why this particular channel doesn't make that much money, Bob, is because I don't advertise financial products, because I generally believe if they're paying me to pump it, it can't be that good of an investment. So I'm not going to tell people watching my channel to go put their money in this. But, if they're paying Arnold Schwarzenegger or whatever actor is in vogue at the moment to pump this stuff, well, Arnold's take home from that ad is being built into the price of what you're buying. So, you're not buying a safe investment sheltering your money from inflation. You're buying maybe half of that, and then the rest is going to Arnold and the guy hiring Arnold and the sales rep who brokered the deal and the commissions on him. So a couple of things to watch out for there.
Yeah, you see a lot of this, especially recently as metals markets have slowed down. You've seen this, gravitation to a lot of these online dealers saying, "God, I've sold billions of dollars of metal over the last 30 years." And what they're not telling you, though, is the markups that a lot of their clients have paid over those years. And luckily the metal prices have gone up, but there are a lot of times when those years the prices didn't go up at all, and the client was forced to sell, and they ended up taking losses because of those bigger markups. And that's that's something to watch out for. You just got to watch out for the marketing that a lot of the dealers out there and promoters will use to try and grab your attention. It's sort of like almost like watching a male peacock, during breeding season, kind of, widen out those feathers a little bit to get the female attracted. It's just very similar into the precious metals world. You want to be very careful with the type of puffery and exaggeration of marketing that people go through.
Well, Bob, once again, I want to thank you very much for taking the time to share your wisdom with us and to share your experience. Always a pleasure to talk to you. You always, especially on that Costco story, you really help separate the hype from, okay, here's what's really going on. It's just people gaming the system. Something clicked when you were talking about that Costco story. So I really appreciate you doing that for us. Now, interestingly enough, I noticed your background's a little different there. You got a new mic, you got a whole new setup here. What is going on at Idaho Armored Vaults that we have all this new setup?
Sure, I appreciate it. We're getting ready to basically set up a new media company. It's called the Happy Hour, spelled out HWPY hour, and that HWPY stands for Health, Wealth, and Protect Yourself. So not only are we a depository, Idaho Armored Vaults, but we also run a sort of a defense supply company called Black Box Group. And then also we're very big into health as well. And so it's an idea of not only how to make money or maintain it, but also how to keep yourself healthy so that money will last. And then at the same time, because we're 24/7 on guard against, I don't want to say the end of the world, but you're protecting a lot of value here. How to use certain pieces of equipment, to protect yourself and your family, that type of thing. So, we get involved with thermal imaging and night vision and level 4 body armor. But what we've figured out was we have so much knowledge base and contacts in a lot of these industries. We're going to start bringing those types of people into the studio and start talking about this, as well as sort of Idaho Armored Vaults employees and so forth, sitting around a table and discussing the precious metals markets, having them ask me questions and having a little bit more two-way dialogue, because it is difficult. I love being on your program, but and others, but a lot of these programs are sponsored by dealers, so you really don't get a chance to talk about the negative side of the industry because it may hurt the advertising budget of that podcast. So this allows me to sort of be a little bit more open, a little bit more longer formatted, hit certain topics, maybe do some short answers, that type of thing, have some more interaction, maybe do it more live, where people can actually shoot in questions on the fly. I always like that to try and get engagement. So, just try to broaden the audience.
Well, I'm really looking forward to that. I've often said, normally I missed it in this one because normally when we're in your office, I can usually see the guys walking by in the background, and I'm always interested in what they happen to be toting around with them. Bob's guys get all the best toys. So, and it was we had a long conversation with you and Kobe when we got together in Vegas talking about that. It's a really neat business model. You're right. When you have a small army or a big army on staff and you already are training and doing all this stuff, you're basically set up to already deal in these things. So the two businesses go hand in hand. It's a really interesting concept and I'm really looking forward to it. And I tell you, I get a lot of messages from people who always say things like, boy, am I glad I got out from the monetary system or the financial system, all these crooks. I talk about all the various frauds on my channel. And people say, well, I'm safe from that now because I put all my wealth into physical gold and silver. Okay, that's great. You are safe from Wall Street, but are you safe from a guy kicking in your door? Are you safe from a guy, you're telling a YouTuber right now that you just put all your money into gold and silver. Maybe we want to keep that to yourself, and a little bit of investment in personal security is a very good idea, especially for precious metals investors. So I'm really looking forward to this.
Sure. No, and the idea as precious metal investors, we worry about the economy, we worry about a recession, and one of the things people don't necessarily pick up on a lot is when you get that recession or depression, crime comes along with it, and people start to become a lot more desperate, and so. It's just something to be aware of. I don't like the fear monger. It's just something that's reality, and how to protect you and your loved ones. That's key in this type of environment.
And, one of the reasons, that's a great point about the crime that comes along with recession, because I think we have a tendency to treat financial crimes and financial criminals with the soft gloves, or, they don't get the severe sentence. Somebody could steal millions of dollars and spend less time in prison than a guy who knocked over a 7-Eleven. But when you think about it, when you destroy the livelihoods of thousands of people, when you steal the retirements like that one crook did, what was it, 670 elderly couples, right? How many people now, how many marriages are destroyed because of that? How many 7-Elevens get knocked over because now you've got hundreds of desperate people? How many drunk driving accidents happen? How many crimes take place because of this? And I'm not trying to scare people here. I guess I'm getting a little too doomy, but most people will admit fraud runs rampant these days. We see it in every corner of finance, and white collar crime gives birth to blue collar crime, if you will. For every white collar crime that is committed, I think you probably get several of these more traditional crimes that happen. And based on the prevalence of fraud that I'm seeing, I think you're right. I do think there is, unfortunately, a surge in violent crime on the horizon. So it's a good time to pay attention to your personal safety. And maybe I'll tone it down there because I'm getting a little doomy even by my standards here. So
Sure.
Once again, guys, that's Bob Coleman, the CEO of Idaho Armored Vaults. I'm going to put a link to his website down below. Also, his Twitter feed at Profits Plus ID on Twitter. He's a fantastic channel to follow on Twitter. These things about the scams that are going on and red flags to watch out for, you can always pick those up on Bob's Twitter feed, which is usually why I notice those and I bring them on to talk to you guys about it. So thanks again, Bob. And I guess I'll give you the last word one more time before we wrap up. Anything else you want to mention?
Yeah, no, I think we kind of gone through a lot. I appreciate the opportunity to be on your program as always. Just try to take for people out there, seeing all this volatility, just take a longer term approach. Don't try to get caught up in the nuances of like, oh my God, I got to get out. I got to hedge. I got to do this. Yeah. Just, the longer term view, I don't think has changed. We would see it in, a lot of different currencies as well as the debt markets. And so far, all that's happening is this attempt to try to refinance government debt at the end of the day. And that's the game that I think we're all kind of focused on, because that's the bull in the china shop. So just keep that in mind.
Wise words as always, Bob. Thanks again for your time. And everybody else, until next time, live small and dream big.